Michael Burry has been dubbed as the king of short selling as he predicted the 2008 recession dot-com bubble and now the largest market crash known in US history. He recently alarmed the people about various indicators that signal a massive crash ahead. This video is not just any other. I will be presenting and analyzing what are the implications of China's situation and some indicators. This video was not made to spread fear, but to remind you about the risks you should seriously consider as you delve into the market.
Check it out.
Michael Burry gains an enormous amount of money by putting the majority of his earnings to where his mouth is. He averaged a return of 28.6 from 2000 to 2008 and 22.8 from 2016 up to date. These returns are on the same level as the most prominent investors. However, this doesn't mean Burry knows exactly when the market crash happens. Predicting such phenomena comes with great difficulties which Burry is not immune of. According to one of Burry's investors, a classic Burry trade goes up by 10 times but goes down by half at first, a pattern which may be occurring again. Michael Burry was quick to recognize the 2008 recession and he could be early again. In December 2020, he first warned of a market crash, so he is likely down on his positions at the moment. Nonetheless, Burry has always proven to be right in the end, so his recent prediction may be accurate again. Lately, he shared an article which discussed and elaborated on the micro and macro elasticity of markets and the intuition behind the GIV estimator. You might probably be puzzled about what I just said unless you have great expertise in the market. The title may sound like it's discussing a complex subject. However, it really is just simple. Let's say an investor says, $1 of bonds and purchases, $1 of stocks. What would happen to the overall valuation of the bond and stock market? A simple model would let you know that the bond market would go down by $1 and the stock market would go up by $1. But in reality, that isn't necessarily the case due to the use of various calculations. Based on researchers' discoveries, $1 invested in the stock market would actually result in the market increasing by $5. This is explained through how people buying stocks incentivizes mutual funds to purchase stocks as well. For example, let's say someone invested $10 in the stock market, which leads stock prices to increase by 10. This causes a mutual fund to invest 10 in stocks as well because they want to get in on future returns because that mutual fund invested 10 stock prices would increase by 10 again. Bringing the total increase to $20, that $20 increase would then lead another mutual fund to invest $10, bringing the total market increase to $30. Mathematical models in this report state that every 10 invested in the stock market right now would result in a $50 increase in the overall market. The problem with this ratio is that it won't always stay the same. Burry tweeted that if $5 of incremental market shares from $1 added to stocks and 90% of millennials aka future wealth owners are in the passive market vehicles, that 5-to-1 ratio will get much sillier in time. COVID didn't stop it, inflation might not. #Epiphany. He also added that the first step is to recognize that 5-to-1 is not a natural ratio. It is a product of a paradigm. So, what will continue this paradigm? What may reverse it? This is the knife's edge. Because we are at 5:1, it may go to 100:1 or become -5 to -1. But parabolas don't resolve sideways because market valuations are extremely high. A small negative event couldn't trigger a massive crash ahead. No one can foresee the exact time a market crash is coming, but almost any bearish event can trigger it. Michael Burry thinks we are in a similar situation to the dot-com bubble. He discovered the price movement 15 years earlier than the year 2000 was heavily correlated to the most recent 15 years. He tweeted that there was a 94% correlation between the Nasdaq 100 in the 15 years today and the 15 years to 2000. The S&P 500 shows 95%. This correlation implies that we are at valuations similar to the dot-com bubble. Many of us know that valuations are extremely elevated right now. The PDE of the S&P 500 is reaching all-time highs. The buffet indicator has reached record highs, as well as margin debt, which are loans that purchase stocks. All these indicators show how the market is now on a knife's edge. One negative event could cause the greatest market crash of all time, and that incident could be the collapse of Evergrande. Evergrande, a real estate company, owns over 1,300 real estate projects in approximately 280 cities in China. Sounds impressive? Well, not really. With over $300 billion worth of loans, it is considered to be the most indebted real estate developer in the world, even failing to pay their debt interests. Despite its struggles to attain its $83.5 million repayment, Evergrande struck another deal for a $35.9 million interest payment. As a result, the company's management has fallen into a very tough predicament, forcing them to repay investors with actual real estate property. So, why does this matter? First, Evergrande is not merely a developer in China. It has loaned out of billions of dollars globally. That includes Citibank, JP Morgan Chase, UBS, HSBC, and Bank of America. If ever these banks lose billions of money, they may put on hold their money lending transactions, thus freezing the financial system. Aside from this, the cryptocurrency sector may also be affected. A famous stable coin, meaning for every coin, it's supposedly worth $1. The problem with this is that Tether do not actually have $1 for every tethered coin. However, they claim to have a reserve of holdings to ensure that each Tether is equivalent to $1. Statistically, commercial paper, or CP for short, makes up more than 65% of Tether's financial reserves. These papers are temporary debt notes that companies issue to investors. For context, if Apple were to issue 100 worth of CP to a lender, then the lender would receive interest for a fixed period of time, which commonly lasts 1 year. Though in the case of Tether, the nature of commercial paper that they possess is not entirely known. What is clear is that they must have to own a tremendous amount of such, since it has been reported that Tether holds $42 billion worth of reserves in crypto. This mysterious nature has thus led to the questionable status of Tether's reserves. Recently, Michael Burry took to Twitter to retweet a hypothetical thread which implied that Tether was using CP to fund China property developers. If this was accurate, it would mean that the entire crypto market would crash if Evergrande were to collapse. The thread explained that many people assume the commercial paper in Tether's reserves were a type of loan between the exchanges and Tether. However, the thread goes on to explain that Tether has actually denied these allegations, revealing only the positive facts while keeping the negative truths to themselves. This is why the D-Boss's CNBC interview was considered incredible, as it confirmed the legitimacy and AA rate of the CP, but ultimately failed to gain answers on whether it was Chinese. The risk that comes with commercial paper is categorized into letter ratings that stem from A to C, AAA carrying the lowest amount of risk and C carrying the highest. But even with Tether's AA rated CP that is considered to carry low risk, it is yet to be known if Tether was referring to the borrower's banking affiliates or the actual borrower. According to an article by Reuters, since it isn't necessary to report CP in financial statements, Chinese companies have utilized CP as a legal loophole to acquire funding. Though at the present, developers need to submit monthly CP reports due to the demands of Chinese regulators. Going back to Reuters, their article also pointed out that an investigation of an Evergrande affiliated bank has been conducted due to an illegal loan of about $20 billion. There were points which suggested that Tether was the lender. Primarily due to Tether's shady standing, reputable buyers would never risk doing business with them, let alone borrow billions of dollars unless they were desperate. A notable credit analyzer, Fitch Ratings, stated that credit market risk were posed by stable coins. This was reported on July 1, 2021, right after the investigation of the Chinese bank. This was relatively after the Boston Fed president mentioned stable coins and its involvement in a future financial crisis. Not long after, U.S. Secretary of Treasury Janet Yellen and Fed Chairman Jerome Powell quickly took action on the stablecoins issue. To add tinder to the flame, Jim Cramer, host of Mad Money on CNBC, went so far as to call Tether a ticking time bomb, a nickname given by Cramer's Chinese sources. Cramer reports that despite the action being taken, it still isn't enough to fix the stablecoin situation. But even if we do know that Tether might be funding Chinese real estate developers, specifically Evergrande, why would it matter? Firstly, it should be noted that the investments going into Tether amount to tens of billions of dollars, which is why if Tether collapses, so would the entire financial system. The tweets that Michael Burry retweeted discussed the possibility that Tether may either be buying another developer CP or Chinese bank or fabricating the whole CB concept. And if true, then the crypto universe is basically in the hands of collapsing Chinese property developers. Burry commented on the issue, stating that Chinese CP, not being the Communist Party, may be a bigger deal. To summarize, Michael Burry predicts that Evergrande's collapse could result in a snowball effect that would soon lead to the biggest crash in US history. But even with the shady nature of Tether and Evergrande, I personally side with Ray Dalio's claims that Evergrande's situation would be manageable. Looking at how the market has survived throughout the decades, I just can't see it crashing along with Evergrande's downfall.